Good day. We are back with another monthly commentary video. The month of February is coming to a close. I'm recording this on Tuesday, the 28th. So this is the last day of the month. Every slide is from today or over the last week. Most of you will be getting this in a few days. So if you see something that's outdated, that's why. The theme for this month is nobody said it was going to be easy. This has a 2022 feel to it. Looking back at the month, almost every asset class is down, and that's a bit uncomfortable. Of course, the inflation numbers came in a bit worse this month. There were also talks of the Fed getting more aggressive on the rate hiking cycle. All of that, higher inflation, higher rates, is potentially bad for all asset classes. So I've collected a assortment of charts. These are all over the map. I tried to grab charts from a few different sources this time. So I hope you enjoy this. Let me share my screen. Let us go. All right, I'm going to move my face because compliance says I cannot cover the source. So I touched on this phenomenon during a podcast or during my last video. I can't quite recall, but people keep talking about a recession. And this is an interesting environment where there's 10 things that confirm a recession and 10 things that deny a recession. What this is S&P 500 performance at the sector level through 2/24. So this would have been last Friday, I believe. And this is very interesting. The sectors that you would think would outperform if a recession was on the doorstep are the defensive names, which are industrials, staples, healthcare, and utilities. These have all trailed through the first 2 months of the year. This is not confirming a recession. You would expect these defensive sectors to lead. Conversely, what's leading is what you would expect to trail if we are on the doorstep of a recession. Consumer discretionary, tech stocks, some of the riskiest sectors. So I'm on record saying the market is always right. People can say whatever they want. I prefer to take my cues from the market. This is a big one. This is smart investors voting with their capital saying we potentially think the worst is behind us, right? We're going to be rotating out of defensive names and into more cyclical, risky names because we think there's better days ahead. I'm not saying I agree with that or I deny that. This is just what's happened, and I find this very interesting. Okay. So my opening comments, I mentioned that the Fed was potentially getting a bit more aggressive in raising rates. And I think the front end of the yield curve, short-term maturity bonds, have started to price this in. And you see just this wild spike in short-term US T-bills, right? So bill yields close in on equity earnings yields. And what this basically is it shows in light blue, short-term bill yields, which are hovering around 5%. They haven't been that high in about 20 years. I think just before the financial crisis, perhaps, or maybe it was the tech bubble. Yeah, I think going back to the tech bubble, so 23 years or so. And then the S&P estimated earnings yield is essentially the opposite of a PE ratio. So PE ratio is basically price divided by earnings. Earnings yield is flipped. Earnings divided by price to come up with a percentage. And many investors weigh these two, short-term US Treasury bill yields of about 5%, with earnings yield, so earnings divided by price, to gauge whether equities or bonds are more attractive. When the gap is wide, when the S&P earnings yield is much higher than short-term Treasury rates, equities are deemed more attractive. So when this gap gets wider, equities are more attractive, right? No one really gets excited about investing in a short-term bond that yields 0% when you can invest in the S&P 500, get some dividends. This earnings yield is a measure of attractiveness between stocks and bonds. So this would be a reasonable, attractive trade. And notice how high this gap was coming out of the financial crisis. Equities were deeply sold off. The earnings yield was highly attractive relative to short-term rates. This was an attractive trade, okay? As these two lines converge, a rational investor might say, getting 5% in a risk-free US Treasury bill is an attractive trade to me. I'm going to reduce equities and invest in what I can set my watch to. So, as I've said before, allocation decisions are not made in a vacuum. Investors are looking at the opportunity set. These relationships change. A rational investor might find this treasury bill trade quite attractive given the uncertainty and the schizophrenic equity markets. Okay, we just basically completed earnings season for this quarter. And a lot of folks are projecting earnings to fall off a cliff. So again, this is as of last Friday, more than 1,300 companies have reported earnings. So it's unofficially over. There's a few reports that are going to trickle out over the next couple of weeks. And there's two things to look at here. EPS beat is this dark blue. Earnings per share is EPS. The light blue is revenue, so sales, top line. Just a caveat here, the light blue number, really tough to manipulate. The darker blue number, easier for accounting shenanigans to creep in. But, you know, we assume most of these large companies are highly scrutinized, a lot of analysts. They work with big four accounting firms. We can trust their numbers. And essentially, earnings have come down. If you're looking at this in the context of the last 20 years, earnings and revenue beat rates have come down. So this is basically the percent of companies beating earnings per share and revenue estimates by quarter. So every quarter, analysts on Wall Street predict or project what earnings are going to be for each company, what earnings are going to be for each sector, for the index. They also do that on the revenue side. So there's an expectation, and then if you're above that expectation, that's a beat. If you're below the expectation, then that is a miss. Okay. So looking at this, you might say, earnings were kind of crappy. Revenue was kind of crappy compared to the last couple years or recent quarters. However, there's more nuance to it, and I'm going to read something just so I don't get my numbers crossed. Earnings per share actually beat from last quarter. You can see this dark blue line actually went up. So 65.5% was actually higher than last quarter of 64.6%. And this number right here, a beat rate of 65.5%, is higher than 78% of previous quarters. Okay, so not all that bad. On the revenue side, revenue was slightly worse quarter over quarter, but still, looking back, revenue estimates, revenue beats were in the 78th percentile, so beating 78% of previous quarters. So not bad when you look at the historical lens, kind of mixed from quarter to quarter. This was hardly a disaster. More importantly, a lot of people were paying attention to forward guidance, and I didn't include this, but several of the third-party research companies that we work with track every time recession is said during a quarterly earnings call. And during the last period, mentions of a recession fell by like 70%. So CFOs, CEOs are saying the word recession about 70% less than they were a quarter ago, which is kind of interesting. I don't know what that means. It could be good, that could be bad, but it seems like the C-suite is less concerned with the recession when they're giving their forward guidance and recapping the past quarter. Okay, so let's talk inflation quickly. Of course, there's all sorts of inflation reports. This is the Fed's preferred report. So I know everyone gets worked up over the CPI report, which is the most widely known and widely reported. This is the Services Personal Consumption Expenditure report, excluding housing and energy. Housing is slow to adjust, which is excluded. Energy is quite volatile. That's excluded. We are more of a service-based economy, making less stuff, providing more services, buying more services. So the Fed really likes this inflation measure. And this came in a little higher than the Fed would like. So you see there's a 1 month line, the light blue, which is all over the place. You can see the light blue spiked higher. And then there's some longer term metrics here, which basically just smooth out this services PCE report. So dark blues, the 3 month, still volatile, but less so than the 1 month. There's the green, which is the 6 month, still volatile, but less so than 3 month and 1 month. And then the red line, which is still volatile, but less volatile than the shorter term time periods. Okay, and there's a trend here. Look, improvement in inflation is not going to be a linear straight line. Okay. And this is a testament to that. If you follow this light blue line, I mean, this is extremely noisy. This is an improvement, inflation going down, followed by a spike, followed by an improvement, a spike, a huge improvement. Now it's trending back up. Okay. But if you look at the 12-month and 6-month, right, this high point, the green line is going down, right? Slightly going down. The red line, here's the peak, slightly going down. So the longer trends, the more smoothed out numbers are going down, extremely volatile and disruptive in the short term. You know, you can blame this on the holiday, you can blame it on weather, you can blame it on consumption patterns post-holiday, you can blame it on any number of things. The takeaway is this last month report was not good. This kind of shook people to the possibility that this inflation nightmare is not over. Short term, it's been quite up and down, as you can see over the last year or so. Longer term trends are positive, but there's going to be some bumps in the road. Okay, so this next graph is a commodity price basket. So this is the Bloomberg Commodity Index. And you can see when the war broke out in Ukraine, this just went parabolic essentially. And there was many predictions that higher commodity prices, higher food prices are here to stay. And certainly there's pockets of that. But when you look at this underlying index, it's basically fallen off a cliff. Okay, so I went back and read a bunch of research reports from the spring of 2020. And, you know, a lot of smart folks thought that commodity prices were going to rise year over year well into the future. And this just goes to show it's really hard to make predictions. It's really hard to own commodities. Commodities are trend heavy. So when they're going up, they tend to go up more. When they go down, they tend to go down more. And this is really why commodities are tough to own. In my opinion, commodities are meant to be traded. So at Pure, we don't outright just buy and hold commodities. We do own a slice of gold, but we subject that to our trend and momentum screen. So when gold is going up, ideally we would own more gold. When gold is going down, ideally we would own less gold. But for those of you that work with an advisor that passively own commodities, it's a really tough asset class to buy and hold. And it's a really tough asset class to trade in general. So I would encourage you to look at the last 20 years of commodity performance, and you're probably going to be disappointed. So this is more or less nothing to really take away from here on the current event side. Predictions are really hard. Commodities are not meant to be owned. They're meant to be traded. That's just my opinion, but it's backed by evidence. Oops, did I go? Okay, so I recently published a blog about investment themes by decade, where markets move in cycles. What performed great yesterday might not perform as well tomorrow. And I'm still seeing so many prospective client portfolios that are just over allocated to technology and over allocated to US markets. And that's fine. You can own those companies. It's fine to own US stocks. I'm not advocating blowing out of that. But no, there is empirical evidence to suggest that markets do move in cycles. And when you see this graph here going back to 1900, so this is 123 years of data, the dark blue is US stocks outperforming. The light blue is global stocks outperforming. And there's a clear relationship between peaks in one followed by outperformance by the other. Okay. So this is not a mutually exclusive decision. It's not like I'm saying you have to own all US stocks or all foreign stocks, but in a diversified equity portfolio, one might do well by layering in some out of favor global stocks. Okay. And looking at the most recent period, the last 12 years been awesome for US stocks. To start 2023, foreign stocks have outperformed. So I'm talking about international developed, larger international developed stocks have outperformed. Is that the start of a new trend? I'm not sure. But looking forward, looking at the opportunity set of investments, international stocks could have their day in the sun over the next couple years. All right, a lot of hot talk about the Fed, what they do next. I've got the latest Fed projections. This is the futures market predicting what the Fed does next. Next meeting is March 22nd. Current level of the Fed funds rate is 4.75%. There's a 75% chance the Fed hikes by only a quarter of 1%, so 0.25. There's a 25% chance that they hike by 0.5%. What's interesting is a month ago, at the end of January, the odds of hiking by 0.5% were 0. So right here where my mouse is. A week ago, these odds of hiking by 0.5% were 18%. So 0 to 18%. On February 24th, which was a Friday, they were 27%. And I printed this yesterday, or I published this yesterday. So Monday, the 27th, they were down to 24.7%. So this is very much fluid, although the leader in the clubhouse is for 0.25%, but the odds of a greater increase are slowly creeping higher. Now, there's a lot of debt ceiling talk. I wrote about the debt ceiling about a month ago. I would encourage you to check that out. And look, there's no doubt the U.S. has a spending problem. It doesn't look like anyone in Congress, left or right, has any desire to actually fix the problem. They're content on kicking the can down the road, which works until it doesn't. I saw this post on Twitter. This is from the St. Louis Fed, and this portrays the problem a little bit differently. And I found this very interesting. So what this is a ratio of federal interest costs. So the interest they're paying on the national debt, interest paid on the national debt, divided by our gross domestic product, right? So the size of our economy. What we pay in interest divided by the size of our economy. And in general, this goes back to like 1940, the size of the US economy has grown by roughly 2 to 3 to 4% a year, which 2 to 3 to 4% a year on a multi-trillion-dollar economy is very substantial, okay? So looking at our interest costs divided by our growing economy, federal outlays for interest are quite manageable and stable looking through it with this lens. And I find this interesting because no one really talks about this. I mean, you're not going to see this in the mainstream media. And back to my comments, I do think Washington obviously is a spending problem. Something needs to be done. But when you look at it in the context of the sheer size of our economy, it seems manageable at this moment. That certainly could change. Our economy could shrink. Interest rates could go up. Spending could go up. That would send this ratio higher. But as of now, if you were to draw a line through this, this is quite stable going back over the last 60 plus years. Now this graph, it's very rare that I stumble across something that makes my jaw drop, and I saved it for last on purpose. This is essentially stock returns and interest rates, GDP, inflation under each Fed chair. And I scoured this thing for a takeaway, and I don't really have any takeaways because there's conflicting signals everywhere. I just think this is interesting. So this goes back to every Fed chair since 1951 as of last week, okay? It outlines S&P returns on an annualized basis before inflation and after inflation. So before is nominal, real is subtracting inflation to get the real return. This column is the US Treasury 10-year yield at the start of each Fed chair's tenure and the end. And the delta is just the difference. So some Fed chairs saw the 10-year go up, some saw it go down, some saw it stay flat. And then there's a GDP number, which is annualized, an inflation figure, which is average inflation is the annualized growth of price level from the start of the term to the end of the term. So this is an annualized number from the start of each term to the end of each term. And again, I don't really have a takeaway. This is just confounding, and I find it extremely interesting. So people want to compare the late 70s and the late 80s to what's going on now, a period marked by above average inflation and higher interest rates. But when you look at annualized equity returns, they are the highest on this page, second highest from a real return standpoint, highest from a before inflation standpoint. And I don't know why that is. I don't know if it was an inflection point, if markets were looking forward to lower inflation, if they were looking forward to lower rates. But this is just a good reminder that equity markets can become disjointed from what the economy and inflation are doing. And equity markets often sniff out what's to come, which is why some of these are really interesting, where you have periods of low rates and low inflation, right? So here under Yellen, low rates, low inflation, pretty good returns, very good return. And then just before that, rates actually going down, low inflation, but below average returns. And the financial crisis was baked in here, which certainly has an impact. Higher rates, higher inflation, higher returns, higher rates over here under Burns, higher rates, higher inflation, lower returns. So this is all over the map. And I guess the takeaway is there's no absolutes in investing. There's no black and white in investing. The market is always right. It's going to do what it's going to do. Stocks can perform well when rates are higher, when inflation is higher. Stocks can perform poorly when rates are higher and inflation is higher. Stocks can perform poorly when rates are lower and inflation is lower. The economy, inflation can become unhinged from what the market does. So this is where I pause and say, the more I do this, the longer I do this, the less I know. And I get really worked up when so many people, both professional and amateur, are so quick to throw out their opinions on what happens next. And they have these elaborate forecasts and they just know what's going to happen next. The last couple of years, if we didn't need a reminder, should be extremely humbling for any investor. No one saw any of this coming. What derails us are seldom what people are talking about. No one saw a global pandemic. No one saw Russia invading Ukraine. No one saw the extreme imbalances and disjointedness coming out of the pandemic. No one saw every asset class going down last year. No one saw the market bouncing back in late spring of 2020. Market was down 37% in 30 days, bounced back just as quick. No one saw any of that. So what I'm saying is it's very hard to make predictions. Keep an open mind. Don't anchor to one identity. It's okay to say, I don't know. Steer clear of those advisors or professionals that say they know what happens next. Steer clear of those in your social circle, which are hell-bent on what happens next. And they've moved to all cash, or they've moved to the riskiest corners of the market. It's time to keep an open mind. It's time to be flexible. It's time to be honest with yourself. It's time to build a portfolio that reflects the way that you feel about risk. It's time to identify the game that you're playing, because the last couple of years, nothing has gone according to plan. The smartest people on earth have had egg on their face. There are smart investors that have lost 50, 60%. Okay. So enough of that. I hope you enjoy this. Thanks for watching. Thanks for listening. If you have any questions, feel free to reach out to me at insight@pureportfolios.com. We can give you feedback on your investment portfolio. We can identify potential conflicts with the advisor that you're working with. We can tell you what you're paying. We can tell you if your portfolio has tax drag. We can tell you if you're a do-it-yourself investor and have biases. We can help you unpack a lot of this stuff. It's free. We're not salespeople. We're not going to harass you. So insight@pureportfolios.com. Thanks. See you next time.